As we all know, YouTube is a shining beacon for intelligent discourse and civility. Thankfully, I get to experience it in action on a regular basis, with compelling insights like, "You're a cunt," "You're a dumb cunt," and "Shut up, you dumb cunt." While I agree with all of those things, I admit they aren't very thought-provoking. But about a month or two ago, a person I was trying to have a discussion with made an assertion that I don't think I've ever heard before. They said, "Stocks are moral, and because they are moral, they should be considered a successful method for retirement." This is the first time I've personally ever heard someone specifically argue about the morality of stocks. And so I started to wonder, why might people think stocks are moral? And are they? Now, I have very strong opinions on this matter, and on economics in general. But let me put those aside for now so we can look at some factual information about stocks, how they function, and so on. So, obviously, this is going to be extremely exciting. And after analyzing this information, we can use it to develop a more informed opinion on whether or not you believe stocks are moral. So, let's start by establishing what stocks actually are. First off, stocks and shares are the same thing, so you may often hear these terms used interchangeably. So, a stock is an investment where you essentially own a share in a company. So, for example's sake, let's pretend there is a kitchenware company called Wistful Thinking, or maybe Whiskey Business. You know, because a whisk is a kitchen utensil, and horrible puns are probably excellent for business. Okay, anyway, so let's say you purchase one share in Wistful Thinking. Since you own one share, this means you own an extremely small part of the company now. So having stock in a company means you have ownership in that company, and as long as you hold onto the stock, you have a claim to some of the company's profits. Or instead, let's say you purchase 500 shares in Wistful Thinking rather than just one. With 500 shares, you would then obviously own a little bit more of the company. As long as you own at least one share in Wistful Thinking, you are considered a shareholder. So congratulations, hotshot, now you're an investor. Well, kind of. And that's a quick explanation about what a stock is. So are stocks moral? Defining stocks isn't enough to help us make that determination yet. So next, let's take a look at how the stock market works. Any company on the stock market has a certain number of shares, and the total number of shares each has differs from company to company. Let's say Wistful Thinking has a total number of 100 shares. I know in an earlier example I said you purchased 500 shares, but with only 100 in total now, that isn't possible. So for this example, let's say there's 100 shares total, and you only purchase one share instead. Since you own one share, this means you own 1% of the total company. But most companies typically have millions of shares, so this means that there are presumably more investors, and they usually own small fractions of the company. Sometimes you'll find some already extremely rich people who will buy up large chunks of stock in a company, so one investor can have just an absurd amount of stocks, whereas you can just have one, but you're both still shareholders. Those who have more shares in a company typically tend to be, I guess, on the board of directors, but that isn't anything that we'll go into here. To understand how the stock market works, though, we need to look at why a company lets you buy shares to have partial ownership of the company in the first place. Companies sell stocks to generate revenue for that company. So it's a way to increase their revenue without having to borrow it. So this way, a company doesn't have to take out a loan to obtain revenue. And most companies don't want to take out loans because they don't want to pay the loan back with interest. The same reason that anyone is usually wary of loans. So let's say Wistful Thinking only has stores in the Midwest, but wants to expand its business over onto the east and west coasts as well. But wistful thinking doesn't want to take out a loan to do this because they don't want to pay interest. Paying interest would eat into the profits the company makes, so that's where you come in. Wistful thinking starts selling shares of the company, and you buy a share. So you give wistful thinking your money in exchange for partial ownership of the company and its assets and earnings. That's essentially what buying a stock is. And since wistful thinking has plans to expand across the rest of the country, you buy shares because you think the money you've invested will grow over time, or as the company becomes more successful. Companies typically keep a significant chunk of shares to themselves. Otherwise, they would not maintain any ownership over their company, or if they don't keep any shares to themselves, then if the company does end up profiting exponentially without keeping shares to themselves, they don't really get to receive as much of that profit compared to the rest of the shareholders who have purchased shares and see their stock prices increase. So if you bought it for $2,000 and you only have one share, let's say wistful thinking is just magnificent and it's expanded across the country and it's just killing it. It's just everyone is just so into it and they're buying kitchen utensils just left and right. I mean, Bed Bath & Beyond goes out of business because wistful thinking is just killing it. And so you bought one share at $2,000. Let's say that with the amount of profits wistful thinking is making, that share ends up just tripling in its value. So your one share that you spent $2,000 on is now worth $6,000. Well, that was a hell of an investment. Think if you would have bought, 30 at $2,000 each, if it tripled, that'd be pretty considerable. And that's why a lot of people want to invest in stocks, or that's what most people have the impression of their investment experience being, based on what they learn about the stock market or what its purpose is when you make investments. People have the impression that if you buy a couple of shares, that you will generally see the value of them increase as the company expands and continues to grow. And that does happen sometimes, and it's great when it does, because that way your investment ends up paying off. But that doesn't always happen. Oftentimes it doesn't. And it's important to think about what happens to the people who have bought those stocks when the investment they've made doesn't end up paying off. So let's look at an alternative scenario. Wistful thinking still divides the company into 100 shares to generate revenue for the business, and each share still sells for $2,000. So $2,000 times 100 total is $200,000 total. So wistful thinking will keep 15 of the 100 shares for itself to maintain its ownership and make sure it makes some profit. And the 15 shares that they keep add up to $30,000. So then wistful thinking finds investors to buy the remaining 85 shares. Again, you still bought one share at $2,000. So your share plus the other remaining 84 shares sell for a total of $170,000. But there are inherent risks that come with investing in stocks. You bought shares in wistful thinking with the hope and maybe even the expectation that the money you invested would grow over time as the company becomes more successful. But let's say the company doesn't. Let's say wistful thinking plans to open 5 new stores on the East Coast and sells shares of the company to raise revenue for this. Unfortunately, the company made poor business decisions by deciding to exclusively sell only whisks in the 5 new stores, rather than selling all kitchen utensils and home-related items. And while whisks are a useful kitchen utensil, it turns out consumers don't buy enough whisks to keep these new stores afloat. The ridiculous and unprofitable business decision leaves the company hemorrhaging money and on the verge of collapse. So, what happens to the money you invested? Unfortunately for you, wishful thinking technically has no requirement to pay you back your money. So if the company fails, wishful thinking loses the money of its investors who invested in shares of the company rather than losing its own money. So wishful thinking did this instead of taking out a loan and having to pay the loan back with interest, whether the business ended up being profitable or whether it failed. The loan would have to be paid back. So wishful thinking doesn't want to take that risk. That's why it's gone the route of selling stock. And it's lost your money as an investor. You're out $2,000, and the rest of the investors also lost their money. But it is lucky for wishful thinking that they never took out that loan because they don't have to pay anybody back. But to clarify, in this negative scenario, the company does lose some of its own money so long as it maintains ownership over some of its stocks. So it loses the initial value of those stocks, just like the investors do. But the risk is spread around and isn't concentrated solely on the company when the company sells shares to generate revenue, which makes it an attractive option, among other reasons. This brief overview of how stocks and the stock market work is just to give you a starting point to understand it so we can later look at whether or not you personally think stocks are moral, and then whether or not you think stocks are therefore an appropriate investment method for retirement. There are a wealth of resources you can look at to get more intricate insight into how the stock market functions, and I can include links to a few in the description if you're interested in looking into it. And I know I haven't covered every detail about stocks and how they function here, because I don't want to bore you so severely that you fall into a coma. But if there's any critical information I've left out here, feel free to let me know so I can make corrections or rectify any errors when I upload the second part of this video. Another important thing to mention is that there are specific requirements and regulations in existence to make sure that a company actually has assets before it's able to sell shares of its company to potential investors. So, if a 6-year-old with a lemonade stand wants to sell shares of its lemonade stand on the stock market, that's not going to work out unless the kid submits the appropriate paperwork and adheres to the present requirements necessary to allow a company to have its shares approved to be sold. But I have my doubts that, a lemonade stand could pull through with that, but that's just me. The stock market also experiences frequent fluctuations with varying causes that haven't really been addressed here. And that type of information may be better suited to be its own video later in the future. But for right now, I'm just trying to supply the basics about stocks, what they are, how they work, and why they exist. When we later look at whether stocks are moral in the next part of this video, we will also need to consider how morality itself does not have a singularly agreed upon definition. So that's going to make this tricky too.